This conference will now be recorded.
Well, good morning, everybody, and welcome to this latest Harts webinar on the autumn statement. I'm sure there's going to be a lot of interesting news that's actually come out of it. And for those of you who didn't know, myself and Chris were actually on Sky News last week commenting on the autumn statement. We were both live on Sky News, so if you wanted to catch up on that, then feel free to do so. So this is actually coming from your Sky News correspondence. I'm delighted to be able to call myself that. Not happened at all before. Anyway, we have to read out our usual disclaimer and at the beginning of this. So the following presentation is provided for general guidance only, and professional advice should always be sought before any transaction is undertaken. Individual circumstances can vary, and therefore no responsibility can be accepted by Harts Limited or any of their affiliates for any action taken or any decision made to refrain from action by attendees of this presentation. Bear in mind, we have a lot of online resources for you. So we have our followers on LinkedIn, and we've got lots of followers on there, which is great. Subscribe to us on YouTube, follow us on Twitter, and you can follow us on Spotify as well. And for those of you who don't know, we've got the latest ebook has just been made available to you. So if you want to go to our website, and there's a new ebook on thinking about selling your business, which is going to coincide with the next webinar, which we're actually going to be giving in January. We're having a break for December because it's Christmas break, and I think people have got other things to do rather than listen to us. So January the 11th is thinking about selling your business, but if you want to download the ebook, feel free to do so. It's all free from our website. Just pop in your email address and you'll be able to do that. So that's the end of what I'm going to be talking about, because I'm going to hand over to Chris Bentley, our tax director, and he's going to be giving the presentation. So over to you, Chris.
Right, thank you very much, Steve. If I try and share my screen. What? Share, and then let me put the presentation up. Hopefully.
Yep, we can see that. And if you want to make it from beginning, show slideshow from beginning.
No, that's what I'm just going to.
Lovely.
So here we are. Hopefully, have we now got the front page up, Stephen?
Yeah, you have. And if anybody's got any questions as we're going through this, please feel free just to shout out and mute yourself. Or we've got the chat box in the top right-hand corner of your screen. Just stick a question in there and we'll be able to come back to you and answer that. So over to you, Chris.
Thank you very much, Stephen. So yes, this morning's webinar is on the autumn statements that the Chancellor delivered last week. A few reflections on it, bit of thinking about what it might actually mean, rather than just trying to jump out with the headlines. Before I go into it, the disclaimer's up on screen. Stephen has read it out already, so I'm not going to do so again. So the key themes coming out of last week's autumn statement, or budget as a lot of us keep calling it. Jeremy Hunt said that his objective was to stimulate economic growth. It's not for us to comment on whether the measures he announced would do so or won't do so. We're here to inform you of what it means and how it might change your thinking in terms of structuring your business, how you take your money out, how you plan for the future. There were tax cuts for the employees. That was in the national insurance. For the self-employed, again, national insurance. And for large businesses, full expensing of capital expenditure. There were then, in total, 110 measures in the budget for businesses. I couldn't tell you what most of those 110 were. Most of them were pretty niche, maybe don't affect the tax system. They're not big headlines. There are a lot of them, but a lot of them are pretty small in terms of their impact. There was also a real emphasis around improving the position for the lowest paid. Key word there being paid. Minimum wage goes up more than 10%, and national insurance has also been cut, but only at basic rate level. So if you're a minimum wage employee, you're going to see a big pay rise come April. You're going to see a cut in your national insurance. You're going to be better off. Those who are on benefits haven't seen the same uplifting. I think benefits might have gone up 6 to 7%. So what the government's doing is it's trying to make work pay, particularly at the bottom end. But the cost of that is for the businesses. It's not something the government has taken on itself. Employers' national insurance has not been reduced at all. There was some speculation when the minimum wage increase came out that there might be a cut on both sides, but no, the cuts are purely for the employees, nothing for the employers. There are relatively few other significant changes. In particular, there's no changes to corporation tax rates. There's no changes to inheritance tax rates or allowances, despite speculation, and capital gains tax rates remain unchanged, although, as some of you may already be aware, the annual exemption is cut again from next April. So if we just go through the headline changes in a little detail first, before going on to having a think about how that affects some of the tax planning, tax advice that might be given. So personal tax first. Very much a whistle stop. Your personal allowance, higher rate and top rate thresholds remain unchanged from April. They've been frozen since April 2021 and are expected to remain in that position until 2028. That means that as a consequence of the very high inflation we've seen over the last couple of years, there has been a very significant real terms cut in those allowances. In other words, everyone pays more tax. Some of the particularly nasty high rates of tax cut in at increasingly low levels on the income spectrum. So the high income child benefit charge kicks in at 50,000. I'm told that if that kept pace with inflation from when it was introduced in 2013, it would now be somewhere between 65 and 70,000. So it's affecting a lot more people than it would have done previously. And if you've got someone who's got 3 children and a student loan, which is certainly far from uncommon, actually going from 50 to 60,000, they can be facing an effective tax rate of close to 80%. That's 80. The tapering of the personal allowance also continues to cut in at 100,000. That's unchanged since about 2010. So again, is affecting far more people than it did when the policy was originally brought in. It means an effective tax rate of 62% for incomes between 100 and 125,000. That's your income tax and your national insurance. It also, for those who have preschool age children in particular, can give some very perverse rates around the loss of childcare allowances. So things to watch out for: pension contributions can be a valuable way of keeping incomes below those levels if you've got the money to do so. It also might be the reason why you want to continue to operate through a limited company as opposed to being a sole trader or a partnership, something I'll come on to later in this webinar.
So from a tax planning point of view, Chris, we're probably looking at trying to reduce your income below all these various limits. I know that there's been a lot of stuff in the press about the high income child benefit charge and how unfair it is because it's kind of an off the cliff charge, but really we ought to be trying to keep your income below 50 grand if you can, or certainly below 100,000. Is that right? And using maybe pension contributions or charitable donations to do that. We could do that, yeah.
Yeah, that's correct, Stephen. The question is whether you can keep your income below those allowances. The 50,000 is a very high tax rate, but you will still be better off in almost all circumstances if you go over 50,000. That might not be the case at 100,000. There are, if you have 2 preschool age children and you're trying to access the 30 hours childcare, because that entitlement disappears entirely if one of the couple exceeds the 100,000, it can actually be better off being on £99,500 a year than you can be on £130,000 a year.
Crazy.
So very, very perverse results can arise around those thresholds. So Stephen says, yes, a lot of tax planning will be around whether your income should go through 50,000 or should go through 100,000. And it's those with children who are most affected by those thresholds. Headline tax rates are all unchanged, including for dividends. The one small change we've got is that the dividend allowance, which is £1,000 this year, so a 0% tax rate on the first £1,000 of dividends, will reduce to £500 from next April. I don't think it'll make much difference to most small business owners' tax bills. It'll be another £500 at 8%. Yes, it's a nuisance, but it's not going to change the planning massively. It could well be in wider society where you've got individuals who might have got some shares in one of the privatisations of the 80s or 90s. They've held on to them. They've always been a basic rate taxpayer. They've suddenly got £600. They've got £600 of dividends. It's never been a problem before, and yet suddenly someone's going to be chasing them for a tax return. Similarly, the savings allowance, which for basic rate taxpayers is £1,000, for higher rate taxpayers £500, and for top rate taxpayers £0. Those amounts are unchanged, but given that bank accounts now pay interest, there's going to be a lot of people who will potentially need to either file a tax return or notify the revenue that they've got taxable income for the first time. With 5% interest not being that difficult to achieve now, you don't need an enormous amount of money to make £500 or £1,000 bank interest. So the days when bank interest could safely be ignored for tax returns and tax planning purposes are no more.
I think that's going to affect a lot of people. Obviously, we're going to be doing a lot more tax returns in the future. I'm sure our tax team will be delighted. But you then got the cost of preparing the return as well. So not only are you going to have to pay tax, you've got the cost of preparing a return as well if you don't want to do it yourself. So spread the word.
It's also going to be a headache because people don't typically get statements of their interest anymore, because when they introduced the savings allowance in about 2015, 2016, then bank accounts were paying £0, so you had to have a huge amount of money before you needed to worry about it, or you were a top rate taxpayer, in which case you're probably looking at your affairs quite closely anyway. But it's going to go right the way down the income spectrum, and it's going to cause headaches. The revenue gets details from the banks, so at some point the revenue is going to start chasing people. All of that together, high inflation, freeze on allowances, you're going to see some big tax increases over the years. So despite the political decision to cut national insurance, for most people, taxes are going up. So the good news bit, national insurance, well, I say good news, I'm guessing most people on this webinar are probably business owners, and you are the one group who is unlikely to see any significant benefit from this. Employees will see a 2% reduction in their national insurance from the 6th of January on earnings between 12,500 and 50,000 broadly. So that's basic rate earnings. And self-employed individuals, that's people who are sole traders or members of a partnership or LLP, their contributions will reduce from 9 to 8% from April, again on the same band. And the self-employed will also cease to pay Class 2 contributions from April 2024. They say that there's going to be a system in the background for those who are below 12,570 who previously paid Class 2s to continue to do something on a voluntary basis, and also so that the entitlement side of national insurance state pension credits, for example, will be preserved. Not sure how that works in practice, but we're told that will be the case. Now, if you're wondering why in the employees get 2% and the self-employed 1%, I think if you look at the abolition of the Class 2s, for people on an average self-employed earnings, it comes down to a very similar amount for both employees and self-employed when you put Class 2s and the 1% reduction in the self-employed contribution rate together. However, it's only really going to benefit those towards the lower end of the income scale. The 2% rate on earnings over the higher rate threshold, 50,270, remains, and for employees there is no cut in national insurance, remains at 13.8%. So typical business owner, small salary, £12,000, £12,500, rest as dividends, you'll see no change whatsoever in your national insurance bills. Capital gains tax and inheritance tax. Lots of rumours, particularly on inheritance tax this time around. No changes to rates. No, and for inheritance tax, no changes to allowances. The nil rate band of 325,000 and the main residence nil rate band of 175,000 remain frozen. The capital gains tax annual exemption, though, reduces from 6,000 to 3,000 in April this year. That had previously been announced. Moving on to businesses and business taxes. Corporation tax rates are unchanged. The headline rate remains 25%. The 19% rate remains in place if your profits are below 50,000, with a tapered rate between those two thresholds. However, investment companies pay at the top rate from the first £1 of profit, and if you have more than one company, then the 50,000 and 250,000 thresholds are apportioned between those companies. So most companies will probably pay at more than 19%. The big change that has been quite heavily talked about in the press is something called full expensing, and that's been made permanent. For big businesses, yes, that will be a significant tax cut for them. However, SMEs won't see the benefit, not because SMEs don't get it, but because the annual investment allowance, which allows you to write off up to £1 million of expenditure in each year against taxable profits, already gives full expensing to almost all SMEs. So yeah, big tax cut for big business, but it's giving them something that SMEs already effectively have. Minimum wage. Now, this wasn't strictly in the budget, but was announced the day before, and I think deliberately announced the day before to come in tandem with the budget announcements. The table there shows the rates from April 2024 and the increase in pence. Spot the obvious error I've just noticed in the 18 to 20-year-old rate. It doesn't go up £81, it goes up 81 pence. There were increases are more than the Low Pay Commission who advises the government originally forecast in March. Their submissions say that wage growth was stronger than had been expected, and the government has benchmarked the minimum wage at a set percentage. I think it's 2/3 of median earnings. They wanted to bring the minimum wage rate up to that set percentage this year, and that's why we're seeing an increase of nearly 10% in the main rate. Whereas ordinary earnings, I think, have gone up somewhere around 7%. So that's the justification that's been given by the government for the increase that comes through from April 24. Be careful, because you might have people that, particularly on salaries, that could inadvertently slip below that, and the consequences of underpaying someone by accident are severe. So be careful with those.
I think one other point to raise on that is that if you're giving your lower paid workers a 10% increase, effectively forced on you by the government, then what's going to happen with the rest of your workforce? Will they also want an increase, because the differential between your various levels will be squeezed? So is this going to have an inflationary effect? Who knows, but it remains to be seen, but it's just something to be aware of. So again, not that helpful to employers, but great for employees.
Yeah, and I think, as Stephen says, that was where the hope that employer national insurance might be cut had come from. It's not been, so all of that cost goes to business. And I think the biggest challenges will be not with those at minimum wage, but those a little above minimum wage, and what that does to pay scales, and the need to maintain differentials for increasing levels of responsibility. So if I move on, business rates and VAT. Sectors that are particularly exposed to minimum wage, things like hospitality, leisure and retail. The one bit of good news in the budget for them is the 75% discount on business rates has been extended for another 12 months, which takes it through to 31st of March 2025. I think that will be relief, because a lot of those businesses were expecting to see a big hike in business rates in April next. But there's another 12 months before that kicks in, which will at least soften some of the blow that businesses in those sectors who have a lot of employees at or around the minimum wage will see. On the VAT side, no change to the VAT thresholds, still 85,000. So first, look at a bit of some tax planning and how that looks around from the changes that have been made. Profit extraction. So as I've said a couple of times already, small business owners don't really benefit from this budget. In fact, the way most small businesses are structured, you could argue it's actually detrimental, in that the benefit of dividends has eroded further. So on the right-hand side, we've got a comparison of effective tax rates. Now, what I've looked to do there is say, if I've got £100 of profit and I want to take it out of the company, how much am I going to have after all taxes have been paid? So that takes into account corporation tax, income tax, and national insurance. The maths behind some of those numbers are quite complicated, and I don't propose to go into them. But what you will notice in the basic rate column is that in the current figures at the top, there is sole trader or partner, 29%. If you structured that way. If you take your money out of your company, pay as you earn, it's a little over 40%, whereas dividends, your effective tax rate is 31%. So that's why most people go, yeah, we'll have a limited company and I'll take my money out, small salary, the rest as dividends. Going forward, so at the bottom end of the table, April 2024 and the basic rate column, the business that operates as a sole trader is now being taxed at 28. Someone who operates through a small company paying themselves dividends is at 31 still. The person who takes the money out, pay as you earn, 38.5. So those two numbers are coming close together, and it's cheapest to be a sole trader or a member of a partnership. Going across into the higher and top rate columns, you'll see the difference is still there. The cheapest way to be constituted is a sole trader or partnership. Pay as you earn, more expensive at high, but the most expensive way to take your money out at higher and top rate is actually dividends. Now, there are still other reasons why you would want to be a limited company and take dividends. Those include more ability to split income with a non-working or lower earning spouse, but also, and perhaps more importantly, for many individuals, it's the ability to control the level of the income on which you're taxable. So the company pays tax on its profits as it arises, but as an individual, you only pay tax on the money you take out. So if you're looking to keep your income below 50,000 or below 100,000 for the reasons that we discussed earlier and some of the extremely high tax rates or even cliff edges where having extra income can end up costing you a significant amount, then that would be a good reason why you'd want to be operating through a limited company. What it is saying though is it might be preferable to be self-employed or a partnership if you're setting up a new business rather than going straight to a limited company. It might even be preferable to take drawings through the pay-as-you-earn system. If you're over state pension age, that may well be the case already. The figures already up there assume someone is of working age and so pays employee as well as employer national insurance contributions. If you're over state pension age, employee contributions fall out and the equation shifts. As I've said below, the advantages of a limited company remain for income splitting and cash retention in a company. However, what I will say is that it does feel like the government does not like small businesses operating through a limited company. There have been a number of times when rates have gone up on dividends as well as national insurance, but then they've come down on national insurance, but dividends have been left up. It's never been spoken as an objective, but you do wonder.
I think as well, we've just got to mention there are other non-tax reasons for doing it as well. Obviously, with a limited company, you've got the limited liability aspect as well, and there may be other non-tax reasons why you'd still want to operate through a limited company. So just have to bear those in mind as well.
Bear those in mind, although there is the halfway house of the limited liability partnership, which gives you the limited liability, but the lower tax rates of being a sole trader or partner. They went out of fashion because a lot of people used them 10 years or so in avoidance structures, but I think they may well come back in again because they give you the tax efficiency as well as the limited liability. And interestingly, a lot of big professional firms remained as LLPs throughout, albeit for different reasons. So I suspect we may see more LLPs again in the future. Other tax changes to be aware of. Research and development, quite broad in its application. It used to be the tax relief that the revenue wanted to claim. Unfortunately, the claims industry crashed for cash. PPI, cavity wall insulation, you name it, that industry arrived on the doors of R&D a few years ago. They've spoilt it for everyone. The government had to act because the professional bodies were telling them that there are too many I'm going to use the word dodgy claims going in. Some of the stories I've heard of things that have been claimed, one of which was apparently there's currently around on care homes they're looking at. Care homes have been claiming R&D for bespoke meal plans for their patients. That's a million miles away from R&D, but people have been trying to claim it, and the revenue is now shutting down on this. As a consequence of all this activity, if you are doing an R&D claim, the revenue have increased their compliance activities tenfold. They're attacking good claims as well as attacking bad claims. They're attacking them hard. They're making it difficult for people to defend them. It's not a pleasant environment, even if you are doing R&D. They've increased the amount of support and compliance that you have to do around them. And on top of that, for small companies, there has been a very significant cut in the value of the tax relief. Going forward, the benefit is going to be 15 pence for every pound of qualifying expenditure. Historically, and we only have to go back about 12 months, that was close to 25 pence for every pound. So massive cut in the value, plus will make it much more difficult for you to claim. I think they're trying to move the relief really towards larger companies because they trust them more. The larger company scheme is becoming more generous, and we're seeing that through a merger of the large and small company schemes for accounting periods beginning on or after the 1st of April 2024. My comment about the further reduction in the value of the scheme applies to SMEs. Large businesses, that's not the case. They've had an increase in the value of their scheme. The big change for SMEs is how it's accounted for. Instead of receiving additional tax relief, SMEs will, going forward, receive a tax credit equal to 20% of the qualifying expenditure, which is then taxed. Putting a 25% tax rate against your 20% tax credit gives you a 15% benefit. Interestingly, loss makers will only be taxed at 19%, so we'll see a slightly larger benefit. In most cases, if you're a profitable business, that tax credit will be offset against other tax liabilities. One of the big differences between the old SME scheme and the old large company scheme was that under the SME scheme you could claim for expenditure which you had subcontracted to others. Large companies couldn't do that. So going forward, everyone will be able to claim for expenditure that has been subcontracted to others. So in other words, the benefit is going to go to the person who is actually bearing the risks of doing the R&D. I think if you've got a large company further up the supply chain who's sending something to you, it will be looked at a lot more closely than it had been in the past, because the revenue won't want the large company to claim for it and you to claim for it. So again, it'll be a further obstacle on SMEs claiming, because a lot of that relief will now be transferred to the large company. Overseas, so restrictions on overseas activities are going to come in from April 24. The logic is that the government only wants to give UK tax relief to work that's done in the UK. Separate to that, grant funding has previously precluded claims under the SME scheme. It's pushed them out into the large companies regime. With the changes from April 2024, that goes away. And the one other point we'll have is that will remain a separate regime, a more generous regime for R&D intensive SME companies. The threshold of that is over 30% of all expenditure on of all the company's expenditure qualifies as R&D. So it's going to be very similar to the current scheme, and the tax relief will be more generous. I think this is going to be startups and out-and-out R&D outfits. It'll probably be fairly clear that someone is into that regime. I think a lot of businesses that are doing work and have done some R&D on the side, that's not going to be available to them. But it is worth bearing in mind if your whole business is R&D. So another big one, making tax digital. MTD stands for a number of things, one of which is making tax digital. It applies to landlords and sole traders with turnover of 50,000 from April 2026, and that threshold will be reduced to 30,000 from April 2027. The good news is that there are now no firm plans to reduce that threshold further. Previously, they were talking about reducing it to £10,000 a year. We could have been in a position where someone who had £11,000 of rental income gross and £11,000 of trading income gross, no tax liability because their expenses took them below the personal allowance, would have had to have completed a total of 11 tax returns a year. Thankfully, that bizarre situation isn't going to arise going forward. The bad news is it's perhaps not been relaxed as much as the professional bodies would have liked. It can still be a fairly onerous compliance obligation. You're still going to have to do quarterly updates from software. The good news is that they've been simplified. So if, say, Q1 update is a bit of a mess, then you don't have to correct Q1 update. Going forward, you'll be able to do a Q2 update, which is 6 months, that corrects everything, and you just give the revenue 6 months. There are also some easements planned for joint owners of properties, which was an area that previously looked like it was going to be horrendously complicated. The headline is, it's not going away, it's not gone away, but it might not be making things quite as difficult as previously planned. And then some other matters just before we finish. The cash basis is going to become, from April of next year, the default basis for calculating income tax on trading income. So if you're a sole trader, partnership, LLP, you can move to the cash basis as opposed to doing accruals accounts. Now, I think some businesses, barristers is one where you get paid very late, may really, really welcome this because it gives a big tax deferral. Other businesses, particularly if you're more than a very small sole trader, doing cash accounting, does it actually give you a full picture of what your business is doing? You might actually be preferable doing accounts and doing it on the same basis that you do at the moment, because those accounts give you a position of a picture of what your business is doing. And that would be particularly the case if you are anything more than very small. If you've got a business where you're not currently running a limited company, you've got half a dozen employees, and going forward you decided, actually, I want to be an LLP. We got to an LLP. I think those sorts of business will probably want to do proper accruals accounts to see what the business is doing. And the tax deferrals are likely to be relatively small. But for others, particularly some small sole traders, I think this will be welcome. The requirement for employees to file a tax return if they have more than £150,000 of income, that has been removed. So if all of your income is pay as you earn, you're not going to have to file a tax return going forward. Historically, that was at 100,000. It's gone up to 150. I suspect due to the withdrawal of the personal allowance, we could have a lot of those people coming back in being asked to do tax returns because PAYE systems malfunctioned, or there's other income at the sides which hasn't been taxed, and then the revenue tries to sort it out afterwards. There are minor changes to IR35 to avoid situations where previously people had double taxation. So that's fairly niche but welcome. And there are also, for those who are currently paid gross through the construction industry scheme, the revenue will be checking them and their compliance records a bit more closely going forward. And then that's it on the budget, the autumn statement side of things. The next webinar is one which Stephen will present in early January on issues to consider if you're thinking of selling your business. So at that point, I will ask Stephen whether any questions have come in, or if anyone wants to raise any questions.
Yeah, if anybody wants to raise anything, then please let us know. Stick your question in the chat box or unmute yourself. Feel free just to shout out and ask anything that you like, and we'll try and answer it. As I say, if you missed anything, it is on our YouTube channel later on today, this webinar, so you'll be able to catch up on anything that you've missed. But if you've got a question, shout out or unmute or chat box, use anything that you like. That's fine with us. I think it's interesting to see what the overall effect of is the autumn statement is that we've got an election coming up in a year or so's time, if that, and it's a little bit of a giveaway, but we've taken away a lot as well. So it's just something to bear in mind. We have had one question in, and this is from Ian. On capital allowances, is this restricted to only new plant and machinery, or is it extended further?
The AIA doesn't have to be new. I believe full expensing will have to be new. But that is, I think that's the case. It's not something I'm exactly sure on.
So the AIA will take you up to £1 million? Yeah. So if you're spending more than £1 million, you go for the full expensing if it's new equipment.
Yeah, and there's also there are restrictions on integral features in terms of how they're treated. So you might want the AIA anyway.
Anybody else got anything they want to ask? No, I don't think we've got any more questions. So thank you very much indeed, Chris, for presenting this morning. Thanks for everybody for joining us and joining us over the last 12 months or so. We've got a great new schedule being prepared for next year as well. So watch out for those. Go to our events page on the website, and we'll be sending out some emails for you. So it just remains to wish you all a very happy Christmas, and I hope you enjoy yourselves over the break, and we look forward to seeing you in the new year. Thanks very much indeed.